This is Mark Zandi. Welcome to Inside Economics. Thank you for joining us today. I'm also joined by a few of my colleagues. Of course, Ryan Sweet, Director of Real-Time Economics, and Chris Dorides, Deputy Chief Economist. And we have another one of our colleagues who's going to participate in the conversation, Bernard Yaros. Bernard, say hello.
Hi, guys. Hi, Mark. Hi, Chris and Ryan. Happy to be here.
So Bernard, how long have you been at Moody's Analytics? How long have you been working with us?
About 6.5 years, closing in on 7.
Wow, I didn't realize it was that long.
Yeah.
I bet you guys don't know about Bernard. Bernard is he's one of these guys who knows everything, pretty much everything. I think he knows like 10 languages. Am I wrong, Bernard? How many languages do you know?
I'd say I'm fluent in 3, but I can hold my own in about a couple others. So.
And one of them, I think, is Arabic, right?
Yeah, Arabic. Yeah.
Oh, wow. Which is pretty tough language to know. Yeah. And you spent some time kind of just wandering the Middle East or something.
I lived, after college, I lived a year in Yemen. So I got to experience, the Arab Spring back then, that was occurring at the time. And then I worked for a year or so as a journalist in Tunisia, which was actually the birthplace of all the Arab Spring revolutions at the time. Then, I went back, to grad school, did economics, and then joined right away at Moody's.
Where in Yemen were you? Were you in Sana'a?
In the capital. Yeah, in the capital.
Oh. So this must be very disturbing to see what's happened there since you left.
Yeah, it's very sad what's happened. I left really before the conflict got out of control, but it was already, you could already see, the writing on the wall. There was basically civil strife. It wasn't until a couple years later that really the Saudis intervened, and that's really when the human toll really took a turn for the worse.
Yeah, your internet just cut out a little bit, just so the listener knows that there was just a gap there. You were talking about the meaning of life, and you were going to tell us what the meaning was, and you just cut out at the last minute. But just so the listener knows. Also, you're like a squash prodigy or something. Like, I remember this because I used to play a fair amount of squash, and you were legendary in the squash courts of Philadelphia, as I recall. Is that right?
Yeah,
you still play squash?
I don't. I tore my Achilles when I started at Moody's. Actually, I was in a cast for several months. So after that, I never, after that, I've never played. So.
Yeah. Hey, did you know this, Bernard, about Chris? He was about ready to turn pro in bocce ball. Did you know that?
I heard the last episode. Yeah.
Yeah. Like, I don't, Chris, why didn't you turn professional? I can't remember.
I missed out on the scholarship, right?
That was it, the scholarship. Damn. So you would have been like, if you go pro in bocce ball, is that like a big deal? And you can make a lot of money doing that?
Oh, certain circles, yes.
So that means if you had gotten that scholarship, you would not have been an economist. You would have ended up being.
I would have never had to pay for a coffee again. Right?
Right. Very good. Very good. Well, we've got a very talented group. And I should say, Bernard is with us because Bernard is critical to our analysis of federal fiscal policy. So every time a new proposal is put out there, everything from the CARES Act a year ago to the $900 billion COVID package at the end of last year, the American Rescue Plan, the Biden Build Back Better agenda. Bernard goes into hyperdrive and helps us evaluate what the macroeconomic consequences of those policies are. So we're going to talk about fiscal policy, and we'll come back to that in a few minutes. But as you know, because you are regular listeners to this podcast, it has 3 parts. Part 1, we go over the key statistics of the week. We're here talking to you Friday afternoon, so we've got a whole week worth of data. So we're going to talk a little bit about that. And I'm going to add a little twist here. I'm going to ask everyone to identify 1 or 2 statistics that they think listeners should be following regularly to gauge something important about the economy. And we'll come back to that. And part 2 is the big topic. And this, because Bernard's with us, it's going to be about federal fiscal policy. So there's a lot to talk about there. And we'll dive into that. And then finally, part 3, I'll pull it all together for everyone and give you a sense of, based on the conversation, where where we landed. So that's the script moving forward. So the data. I usually start with Ryan, but let's mix it up a little bit. Oh, and I should ask Bernard, do you want in on this kind of part of the conversation too, or do you want to wait till the fiscal?
I've got my
You got one.
statistic. Yeah.
Oh, you got one. Okay. All right.
yeah.
Okay,
Prepared.
baby. All right.
Came
So we're coming
prepared.
back to you, but I'm just, because, these other guys have been doing it for a while. They're going to show you how it's done, So,
Okay.
all right. All right. Chris, what's your statistic of the week?
All right, $1,453.
$1,453. $1,453. You guys know what that is? Bernard,
I'm
Ryan?
thinking.
No.
That's a tough
well-
one. Can you give us a hint, Chris? Or are you going to give it away if you give us a hint?
That's housing related.
Yeah,
1,400.
he goes to that well.
I know he's a housing guy. Housing market. I knew it was housing related, but I don't know, Chris. What is that? Oh,
No,
Ryan's got it. He
No,
always comes
no.
in, comes through. Come on.
I don't know this one.
well, we got existing home sales. We got housing starts, but none of those. I can't think of anything in those reports this week that go to 1,400. Is it? Can I say? Is it the average or median monthly mortgage payment?
Oh, that's a nice guess, but it's not
No,
right.
Oh, really? It could be right. It could be right because you don't know if it's right or wrong. But damn, it's got to be pretty close to 1,000.
I'm gonna look it up. I'll look it up.
The average mortgage payment. I defy you, someone out there, Bernard. While you're waiting, look it up because Bernard gets to the statistic. Look up just Google. Say, I think it's more like the average as opposed to the median, but average or median. Okay, so what is it, Chris?
It is the price per 1,000 board feet of lumber. So it's the
I
lumber
should have known
price.
that one.
And that is down 15% from the peak, which was just 2 weeks ago.
Really?
Peak was 16, 17. Yeah. So lumber prices have been coming down, but they've been very volatile, right? So there's still lots of volatility. But
do you think they have peaked though, or are we on the other side of this surge in lumber prices, or is this just data, just the volatility in the data?
I think we might have peaked, but I think we're going to remain at this elevated level for a while. So we'll probably bounce around for a while. But I think a key point is that commodity prices certainly can and do adjust very rapidly, right? This is 15% down in 2 weeks. There's been a lot of inflation talk, certainly, and I think that's valid, but commodities have a way of adjusting very, very rapidly. So if it's not the peak, I do foresee that we will see some correction later on this summer, certainly as things continue to settle down.
Yeah, and we talked about this a couple of weeks ago, maybe several weeks ago, and there's a bunch of things going on here. But as I recall, the key thing is a lot of sawmills shut down during the pandemic, and there's just taking a bit of time to get those sawmills back up and running. Do I have that right?
Well, what I've heard is that the sawmills are running at capacity, but there's very little desire to expand capacity at this point, right? Because if the sawmill owner thinks that this is a relatively short-lived phenomenon, demand is really strong now, but it could taper off later this year, then they're not going to make a big investment. They're happy to collect the dollars that they can now and wait, right? So I think we have a little bit of a cat and mouse game, right?
Got it.
They need a clearer signal that this is here to stay, or that these prices are going to remain elevated. It isn't just speculation that's going on as well. So,
but presumably they could still make a boatload of money even if the price of lumber was cut by a significant amount. They could still make a lot of money here. Yeah, they could,
but it's not. Putting on another sawmill takes some time. It's not a costless endeavor, right? So.
Yeah. While we're on housing, housing statistics did come out, the housing starts numbers, and that was a bit on the soft side for single family housing starts. And home sales also, existing home sales, they're strong, don't get me wrong, but they're down. They were 5.85 million, I believe, which is well below where they've been in the last 6, 9, 12 months. They were well over 6 million units per annum. Do you think we're seeing now a more of a moderation in housing activity? Is this, again, just data, statistical noise, or do you think we're starting to see some coming back to earth of the single family housing market based on this data?
I think we are starting to push up against the limits, and lumber plays into this as well. So some of the decline in lumber prices might be builders responding as well, that they're just not going to build, or they're not going to accept that price, right? So I think we will see some moderation, but I do expect the rest of the summer for demand to remain quite high. So I don't think this is going away, or that we'll see a sudden correction, but I wouldn't be surprised if we're at the top here. We might just bounce around at this level and then gradually come back into equilibrium later this year.
And I
So
suppose
lumber is definitely impacting the new housing market.
Mhm.
The existing side, it's lean inventories. So in April, homes were on the market 17 days, which is ridiculously low. This time last year, it was 27 days. So their housing turnover is just extremely low. And I think existing home sales are going to go a little bit further lower before we bottom out. So Chris, you got to look at your existing home sales forecast. It looks a little optimistic
oh, does it? Oh,
for the end of the year. So in our baseline, we have 6.2 million annualized housing existing home sales. I think it's going to come in closer to 5.5.
yeah. So
All
we're
right.
saying that the kind of moderation in construction and sales is more a function of supply constraints, inventory constraints, than it is any weakening in kind of underlying demand for housing.
Yeah, and some
guess that-
payback was due. I mean, existing home sales went parabolic in the second half of last year. So,
Yeah.
we're still, like you said, we're still running at a very strong clip of existing home sales. It's just, we're coming off the boil.
Yep, got it. I should, just as an advertisement, say next week our podcast is going to be on housing and housing finance, and we're going to get Jim Parrott to come in and speak. Jim is a good friend, and I've written a lot of papers with him on most recently on the housing supply shortage, but of course we've been the last decade writing a lot of papers on housing finance, GSE reform, that kind of thing, and it'll be really good to have him. I hear he's pretty funny, so that that'll liven things up. Okay, Bernard, before I go to Ryan, because Ryan is the pro at this data, but I'm going to turn to you. So what's your statistic?
So my number of the week is 2,856
Oh, we just lost him. Can you believe that?
That internet connection in Boston.
Yeah, damn Boston. Yeah.
dollars.
Yeah.
All right, you got to repeat it, Bernard. You froze again.
You
Okay,
froze again, Bernard.
So my number is $2,856.
I got that one.
2,800 and you do? Okay, go ahead, Ryan. What is it?
Tax refunds, average tax refund.
Yep.
You're reading, because you read everything Bernard writes for the Economic View website. There,
No, exactly.
Yeah.
And it's a timely statistic because obviously this past Monday was the extended deadline.
Right. So we'll come back to refunds when we get to the big topic, the fiscal situation. But just to give some context, is that a large refund, or is that typical, or how would you think about that?
It's about 3 to 5% higher than in past years compared to the average refund at comparable points of past years, and it just shows that in general this tax season has been shaping up to be quite good for the taxpayer in the aggregate, at least.
Okay, and the number of people getting refunds, is that up as well?
So the aggregate number of refunds, if you look year to date, that's also tracking up slightly above, not much above, but slightly above the past pace in prior years.
Okay.
And obviously it's going to get even better, and we can talk about this more because of the American Rescue Plan. Starting in midsummer, you're going to start having these monthly child payments that are also going to come in the form of refunds. And that's going to hit as soon as July and going all the way through the end of the year. And that's, we're talking about another 50 billion in refunds that are going to be in advance on what would normally occur.
Is that, you said 50 billion, is that 50 billion over what period of time?
50 billion between July and the end and December.
Got it. Right. Good. Okay. We'll come back to that. Okay, Ryan, what's your statistic of the week?
76.8. It's a diffusion index.
A diffusion index, 76.8. You guys have any sense of that one? 76.8. I don't know. What is that? 76.8.
It's in the
It's out of our
Philly
misery.
Fed survey, the prices paid index.
Oh, you are really going down into the bowels of this report.
Wow.
Like if you told me, correct me if I'm wrong, but I think the top line Philly Fed index was like 31.5. Is that right?
That's correct. Yeah.
Okay. And now you're telling me I got to now
You
know
got to
the-
you got to dig deep. I mean, the big topic is, the hot topic over the last several weeks has been inflation. And the prices paid index is at its highest since the early 1980s. And it's not a leading indicator for inflation. It's more coincident. It tracks, commodity prices very, very closely. But when you look at the gap between prices paid and prices received, that gap's getting really wide. So one thing I was going to, bounce off you and Chris and Bernard is, I wonder if businesses' pricing power, is not as strong as people are anticipating. Therefore, we're not going to get as much inflation, consumer inflation over the next 6-9 months as people are worried about.
Right. Well, we know that businesses don't pass through a lot of their higher commodity input costs, right? So they eat a lot of it.
Right.
Or they work really hard to navigate around it by substituting out one input for another input, that kind of thing.
Mm-hmm.
And if they think it's temporary, if they think it's a couple, 3 months, that more likely they'll probably eat it. I mean, I think if they thought this was going to go on for a year or two, then they probably have no choice but to pass more of it along.
Yeah, that was my hunch, because if you look at the gap again between prices paid and prices received, it gets this wide when you get oil price spikes, and usually that's transitory and they look through it. So, yeah, I mean, you gotta dig deep. You can't just look at the headline number. There's a lot of important information.
I hear you. I hear you. I think the other thing you do is you kind of put these different diffusion indices we get from different Federal Reserve districts from across the country onto a kind of an so-called ISM basis, so you can compare apples to apples. ISM is
Correct.
the industrial, yeah. And on an ISM basis, what was the Philly Fed? Was it
64?
It did not
in the
come
prior
down.
month. No, exactly.
Yeah.
So there's a big drop in the headline business conditions index.
Right.
That's its own separate question that more often reflects business confidence. And also the way they ask the question is, how are business conditions relative to the prior month? I mean, things were, booming in the prior month. So it's not surprising that, the headline index came down, but on an ISM composite basis, it was still very, very elevated. Similar with the Empire State Survey.
Got it. So what's kind of the broader message here? I guess from it's that we still have these supply issues, and it is because of the improvement in the continued strong demand, we are getting continued price spikes, and it's the spikes are about as large as they've been since, well, the last time inflation was really, really high back in the early 80s. That's kind of
correct, but we're not going back to 1980 style inflation for the U.S. for consumer prices. So I still think the inflationists are still crying wolf. Like, it's not, we're not going to embark on double-digit inflation in the U.S.
Right. Hey, you want to hear my statistic?
Yeah.
You ready?
What do you got?
89.9%. 89.9%. Any ideas? I'm not digging that deep either. I mean, it's pretty much in your face kind of a statistic, especially you, Ryan. Yeah.
89.9%.
Tick, 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 tick.
Give us a clue.
Okay. Well, if I give you this clue, you'll know, but it's okay. Because I'm going to put you out of your misery. 99.8% is the state of Florida. The state of Florida is at 99.8%. Oh, you're still not going to get it. I'm surprised. I thought that.
It's not vaccinations.
No.
It's not. We're never going to hear that.
Oh, I'm surprised. I stumped you. Yeah. Hey, it's the back to normal index.
Oh,
yeah.
Your go-to.
Oh, wow.
Yeah, my go-to, because it's moving up very quickly. I mean, I think when we started these podcasts a couple months ago, it was a little above 80%. Oh, I should say to the listener, we construct this so-called back to normal index, which looks at a raft of different statistics, government statistics, third-party statistics, to gauge where the economy is compared to its pre-pandemic level. So, when I said 89.9%, that means that that the economy by this measure is 89.9% back to normal. Still got about 10% more to go to get back to pre-pandemic levels. And that it's rising now very, very rapidly, opening up. Florida there's no state that is completely back to normal, but Florida is on the cusp. As I said, very, very close. And do you know the state that is at the bottom of the list? Big state that is at the bottom of the list? You probably know this, right?
New York?
New York?
Yeah, New York. Yeah, New York. It's just below 80%. So, but I suspect now that New York is reopening officially, that'll start rising very rapidly. So, to me, that this index has done a very good job of kind of capturing all of the economic data and kind of putting it into one statistic that you can get your mind around. And it's saying, yeah, we're coming back. Oh, but by the way, the bottom, the nadir, back a year ago in the teeth of the shutdowns was 60%. So the economy was 60% of its pre-pandemic level. So we've gone from 60% back up to almost 90%. So we've made a lot of progress here, and we're getting back really very, very quickly back to normal. I did want to ask you I think I mentioned this. Is there a statistic or two that you think the listeners should be watching on a regular basis? And we'll come back to, if not every week, every couple, 3 weeks to just remind people of the statistic and what it's saying that people should be looking at. And here, I'll give you an example, just to give you a sense of what I mean. So, of course, inflation is top of mind. Everyone's nervous that this spiking in commodity industrial prices is going to result in broad-based, persistent inflation that's uncomfortably high. And one statistic that I think would be useful to look like, kind of like a poster child for all of this, is copper prices. I think I mentioned this in one of the other podcasts, but copper prices, we economists call it copper Dr. Copper, because it's a very sensitive price. It gives you, it's global, gives you a really good sense of what's going on globally on a real-time basis. And right now, I looked today, it's at $4.50. That's indicative of a lot of inflationary pressures. Anything over $4 is inflation. So if it comes back below 4, that means we're kind of moving in the right direction. $3 per pound, that would be kind of typical. That's what you'd see on average through the business cycle. And closer to 2, which is where we were a year ago in the middle of the pandemic, that's bad. That's the economy's really struggling. So we're $4.50. So we'll come back to that statistic. I think maybe every week, give people a sense of where it is, and then that gives them some context of where we are with regard to these inflationary pressures. So
something interesting with copper. Something interesting with copper. There was a strike at a Chilean mine, so I think that's put some temporary upward pressure on copper prices. So we have this daily industrial metals price index. So I was looking through to see what's driving this big increase. It's up 20% this year. And it's copper, it's oil, it's lumber, nothing really surprising, but a lot of these are experiencing some sort of supply constraint. So I think that's a huge issue that is likely going to plague commodity markets through the rest of this year.
Yeah, I mean, I think copper was, if I go back a few days ago, I think it was like a $4.90, and that might go to your Chilean strike. Seems to be coming back down a little bit. So. Do you have a statistic you think we should be watching on a regular basis for the listener? Chris or Ryan or Bernard, any thoughts there?
So I'd say on a weekly basis, UI claims, unemployment insurance claims.
Okay.
Come out every Thursday. I eagerly await Ryan's write-up. So, it gives us a good sense of what's going on a higher frequency basis than the monthly employment report. So clearly something you want to watch, and you can see the downward trends over the last couple of weeks.
And where are we now on UI claims?
So this week we're at 444,000.
Yep.
Right.
And what would be typical? What would be we're back to normal?
Well, pre-pandemic we're at 215,000.
215. That was with pretty tight labor market.
That was
right.
That might have been below average. So 250.
I think 250 or 300 would be typical. Things would be better.
Yeah, back closer back to normal. Okay, let's
Yeah.
watch that one on a regular basis. Ryan, do you have one we should be watching?
I'll give you two since you usually don't like
Okay. Yeah.
you don't like mine.
Give some options.
I mean, I agree what you said last week, and I think I would pay very close attention to the 10-year Treasury yield. I mean, I've been a little
like
bit
that.
surprised. I've been a little surprised that it hasn't moved much higher since you got all these inflation concerns, but the 10-year, actually, I think it's down recently. So I was curious what's pushing it lower. The data, the economic data has come in, weaker than the consensus has expected. So there's a city economic surprise index, and it kind of closely tracks changes in the 10-year Treasury yield.
So we're at 1 point, I think today 6.5,
Mhm.
and the bottom was last August, and we hit, I think, almost 50 basis points, 0.5. So we're up 110 basis points or 1.1 percentage points. So if it starts rising, what's your interpretation of that? That the economy is normalizing, that we're getting back to something more typical. And in the long run, what should the 10-year Treasury yield be? I know this may be a matter of some debate.
Wow.
Yeah, we don't want to go down this road.
Oh, we really don't. Yeah.
No, I mean, I think rates will rise, and there's not necessarily a level that is really going to start to hamper the housing market for the next 6 to 12 months. It's the pace of the increase in the 10-year Treasury yield. Because before, when we had this big run up earlier this year, I mean, the Fed we know rates should be rising, but the bond market was going too quickly, and they kind of like jawbone them down. But the other stat, which I'm watching because we have all this excess savings, we're trying to time when we're going to get this big release of pent-up demand for consumer services, the number of people going through TSA checkpoints.
Yeah. Well,
1.7 million yesterday.
1.7 million. In 2019, about the same time of year, it was
3 million, give or take.
Okay. So we're still a million and a half below per day, below where we should be.
But if you
Well,
look
at
at the
least
trend, if
typical.
you squint, you're starting to see, it's improving.
Yeah. But that may take some time to get back. The economy, you might deem it to be back to normal before that gets back to pre-pandemic, right? Because there's going to be a lot of domestic tourism, but I suspect global travel will be impaired for a while and business travel for quite some time.
We read about all these anecdotes of, and you can see it in the CPI data. Lodging away from home prices are rising, rental car prices are rising very quickly. So I'm using this kind of gauge when people are going to release their demand for consumer services like vacations and things like that.
Yeah, got it. Okay, so we're going to watch copper prices. We're going to watch UI claims. We're going to watch the 10-year Treasury yield, and we're going to watch TSA. A number of people go through TSA checkpoints every month and see what they're telling us. Okay, all right, good. Bernard, I failed to ask you. Was there any statistic that you think we should be following on a regular basis?
So on the topic of inflation, I usually like to look at what they call sticky price components of CPI. So the Atlanta Fed disaggregates the consumer price index into flexible prices and sticky prices. And sticky prices are essentially, they're prices that form the basket of goods and services that don't, these are prices that don't change frequently. So if price setters, can only change these prices like for shelter, education, and healthcare only, at very infrequent intervals, they're going to have a lot of, they're going to have inflation expectations in mind. So, and this, these sticky prices are a good indicator of where inflation will be going, 12 to 24 months down the road. So so that's where in the CPI, not all of its components are as forward-looking as others, and these ones tend to be quite forward-looking just because there's a lot of inflation expectations embedded in them.
Got it. Is that you said the Atlanta Fed? You said these?
Yes,
because there's a number of them.
Yeah.
Your favorite is the Atlanta Fed. The kind of the trim meat. Yeah. Okay, that's a good one. Yeah, so we'll be watching that as well. Good. So Bernard, before we kind of dive into the big topic, which is fiscal policy, and a lot to talk about there, anything else you want to tell the audience about yourself? I mean, you speak 10 languages. You're squash prodigy. I know you moved to Boston. That's why there's no internet connectivity there. Anything else we should? Oh, the other thing, you're married to a former colleague of ours too, right? That's an important
Yes,
thing.
yes.
Yeah. How's she
Yes,
doing?
and
By the way?
she's
in
doing
law
well. She just finished her first year of law school, and then just finished a grueling week of this write-on competition to get into law review. So she finally has a few weeks of break before she goes back into the internship, and
And she's a force. She's a real force. I mean, she was.
Yeah, she did a lot of. An interesting fact is during the vice presidential debates, both of our white papers that we did got cited by Kamala Harris. So she did a couple years ago. She did a trade war paper with you and Jesse Rogers, which was cited. And then
Really?
obviously our paper on on the candidate proposals was also cited. So
yeah, that was pretty something. President Biden and Vice President Harris cited us pretty regularly, didn't they? The movies.
Yeah.
Wall Street Economists.
Oh yeah, no. It said Moody's, the Wall Street firm. Didn't they say that? Did they say Wall Street Economist? No, I think they said
exactly Wall Street firm. Yeah.
So and not just once or twice, but like a lot of times.
Mm-hmm.
Yeah, it was pretty amazing. You obviously liked our study, in the work we did, which is good. Okay, so let's turn to fiscal policy. So the American Rescue Plan, that's the $1.9 trillion package of support, COVID support that was passed back. It feels like ages ago, but now it's only a couple months ago in March. That a lot of that money's already gotten out. Is that right, Bernard?
Exactly. It's most of that has, especially in the form of stimulus checks. I'd say the vast majority of the stimulus checks have already gone out right now, and also the UI benefits. That's starting to diminish, and it's going to diminish over time, especially as more states begin to opt out of the federal UI pandemic programs. And then even the White House under pressure is going to start to institute across all states work search requirements. So all of this, these two sources of government income support are going to diminish over time. Where you're actually going to see some impulse, some fiscal impulse is going to come from state and local government funding. So after a long period of dormancy, we're starting to see in the daily Treasury statement that Congress is starting, or that the Treasury is starting to issue a lot of the coronavirus relief funds to state and local governments. And obviously, these are just disbursements. This doesn't really affect the economy right now because it takes time for that to get spent. But at least that money is going out the door. It's going into the pockets of state and local governments. And our assumption is that over the next 3 to 4 years, it's going to be gradually spent out. And it's just going to be a steady dose of fiscal support, especially by state and local governments. Also,
hey, Ron, hey, Bernard, this is a conversation, not a lecture.
Yeah.
So, okay.
Yeah.
So we talk here on Inside Economics. We probe and we try to digest it. I mean, you got to break it up. You got to let us get into the conversation a little bit. Yeah. So
Maria's rubbing off on him.
Is it what's going on?
The lawyer speak is rubbing off on Bernard.
Maria's his wife, by the way.
Right. Yeah. Oh, sorry.
Yeah. Can you imagine their dinners? Like one talks for a half hour, then the other one talks for a half hour, and then the next one talks for a half hour. It's like in my household, I don't speak at all. I say nothing.
Well, we know Bernard's not going to win any argument ever.
No, as I said, he's a force. Yeah. Chris, in your household, I can't imagine you do the talking. Chris
I used to.
Is that right?
I used to dominate, but now my son, 4 years old, he's the commander in chief. So.
Hey, by the way, are you teaching him Italian?
Yeah, for sure.
You are. Okay, very good.
Sure.
Yeah, that's the smart thing to do. Yeah.
Diversify.
Yeah. Okay, Bernard, back to you. So the PPP money, that's the small business program, that's gone, right? That's pretty much.
There's only about, according to the reports I'm seeing, there's only about $8 billion left, and these are loans specifically for underserved communities. So, and these are, these are being managed by what they call community financial institutions, which, tend to serve minorities, women, and just other disadvantaged communities.
Hey, did you know I'm the lead director of the largest CDF, or pretty close to the largest CDFI in the country? Did you know that? Yeah.
No, I didn't. I didn't know.
Yeah, absolutely.
Mm-hmm, mm-hmm.
So yeah, very happy about that. That's very helpful to underserved communities. So the stimulus checks are out. The PPP money is gone. The UI is, starting to wind down, and it'll be completely gone by September. There's rental assistance, and I think a lot of that is already out there. It's finding its way to renters. The airlines have gotten their assistance, right? That was part of the package.
Yeah. Yep.
I guess there's two things left that is yet to get out there in the economy. One of which you mentioned was the big things, I should say. One is the state and local government aid, and that's a lot, right? That's 350 billion, I believe. Okay.
Yeah, and then you have another 170 for education. So it's going to public K through 12, higher ed. Yeah. And that's going to be spent over an even longer period of time, all the way through to, 2027.
Okay. And then there's a child tax credit you mentioned as well, because that was also got, so that's some more funds that are going to be distributed. But it feels like correct me if I'm wrong, but it feels like the largest benefit to the economy, the real boost to the economy from the ARP has happened. It's in the economy. It's happened over the last couple of months. Is that right? Would you?
Exactly. Yeah, it's really the stimulus checks and the UI benefits. And yeah, I mean, that's really, that really was it. The rest of it is very slow moving. It'll take a lot of time to really, to really help the economy, but it's going to come in a lot of small waves. It's not going to be all at once like the stimulus checks.
Right. So the economy is getting this real fiscal boost in the current quarter, Q2, get something of a boost in Q3, and then it starts to fade pretty fast, right? I mean, in terms of the boost.
Exactly. Yeah.
Yeah. Okay. Right.
You think the timing was a mistake with the economic payments? Do you think they should have waited until like now is when they first should have gone out, when the economy is reopening, more people are vaccinated? I think we may have gotten a bigger boost to consumption if it was hitting paychecks now or checking accounts now, that people are going out and doing things more freely rather than ending up in savings accounts. What do you think?
I don't think the timing, I mean, I think if people who are going to save it or spend it, they're going to save or spend it regardless of the timing. And I think, if they had waited to send them out, it also causes more trouble for, I guess it could just be another headache for the IRS, especially at a time when they're also going to be dealing with child payments and other work. So I don't think I don't think timing is the issue, because I mean, if you're going to be spending it no matter what, if you're going to save it, you're going to save it whenever it comes. But I don't know. It might have come to a little bit too soon, but I don't think it's really a big issue.
That big a deal.
What about the argument that it's created a disincentive to work, though?
The UI, or all of it,
or even the stimulus check, right?
Oh, okay. Yeah. What do you think of that? Yeah.
So with UI, UI is in a very, I'll give some UI some credit, because it's one of the most effective forms of stimulus. We've done some past work on multipliers. So, $1 spent on UI will, over the next year, will generate about $1.7 in extra GDP. And it's just, it's an extremely effective form of stimulus. And, you really see how the economy started to level off or slow down in the second half of last year, once a lot of those UI enhancements expired. That said, I don't think the UI benefits are in and of themselves disincentivizing work. I think there's a lot of it's not mutually exclusive. So you might have a lot of people who are afraid of the virus. You have a lot of people who have childcare issues. And, because of the UI benefits, they're able to, maybe wait a bit longer before they really jump back into the workforce. So it's not either or. And then plus, these are it's temporary. Everyone knows that it's going to, these UI benefits are going to expire after September. So it's not something they can count on forever. So if the right opportunity does come, I think the closer we get to September, it's people aren't going to wait just an extra couple of weeks or an extra month until they really start looking for work.
I'll have to say, I'm sympathetic to what you're saying, but I have never received so many emails from people, business people, generally small business people, but people saying, you don't know what you're talking about. That, I'm on the ground here and I'm telling you, people are not coming to work because they're getting that UI benefit that, gives them a benefit that's higher than their current salary. So how would you, if you were getting those emails, how would you respond to them?
I think there's definitely truth to that. And one statistic that I did see that sort of, really caught my eyes, if the New York Fed, they do a survey of consumer expectations. And, one of the things they're looking at is the average, the reservation wage by demographic. And if you look at the reservation wage so the reservation wage is the minimum wage that, workers would be willing to accept in order to, to jump back into the workforce. And for workers, for adults who are without a college degree, you've seen a sharp increase in their reservation wage during the pandemic, which is surprising, given that this is, there's a lot of slack in the economy if you just look at the labor, the unemployment rate. And, I think part of that is really the UI benefits. I think UI benefits have, made workers reassess, how much they're worth or how much they should be getting paid. And it'll be interesting to see how sticky that increase in the reservation wage is, because at some point, if it sticks, at some point businesses are going to have to raise the wages that they're, the entry level wages that they're going to be offering. But it could also be due to
Bernard, on the reservation wage, could it also be though that people are just nervous about going back and they've got family responsibilities, and therefore it's going to take more money to get me back to work at this point in time, right?
Exactly, and I think people have seen the cost, of childcare. They've really also internalized, a greater risk, especially people in high contact industries. I think they've really reassessed, the health risks of, being in constant contact with clients, whether it's, the coronavirus or just, the regular influenza or whatever, there's just the greater realization of some of the risks associated with that, which, could also push up the reservation wage.
Chris, you were going to say something?
Yeah, so whether it was intentional or not, is this a mechanism to get to a $15 minimum wage? Right, effectively, the extended UI is equivalent to that $15 wage, right? And so that has
it could be
produced the floor of the reservation wage.
Yeah, it could be. I mean, I don't know if it's going to create pockets where, or especially in big companies, when you look at McDonald's or other, they're going to have to, I think that's going to put pressure, permanent pressure on wages, at least over the next year. So it is. Maybe it doesn't get up to 15%, but it's $15, but it definitely will increase it from where it's been.
I think supporting Chris's argument is that you see a lot of businesses, even just around where we are in Westchester, Pennsylvania, saying that, we're offering $15, $20 an hour. And I was even listening to the radio the other day, and there was an ad for hiring at Wawa, which I have never heard before. And, they're spinning it to make it more attractive for people to work there, including a free Subway or a Wawa sub. Wawa sub each shift.
Worth a lot. That's worth a lot. Hey,
and a $500 signing bonus.
Yeah, Wawa, for people who don't know, is amazing. It's like a convenience store. I guess that's the right word. That knows how to provide what they do conveniently. It's really great. In fact, have you seen this Mayor of Easton show? And it's set in Philadelphia town, and Wawa is part of the town, of the culture of the town. It's really a very important place. So if Wawa is doing this, then it's got to be happening in lots of different places. Hey, I do want to move on and talk about the future. So the President Biden, American ARP is in train. It passed a couple months ago and is in train. It's going to start winding down here in terms of the support to the economy pretty soon. The next thing up, though, is the Build Back Better agenda, which is the American Jobs Plan, which is the infrastructure plan, and the American Families Plan, which is various social programs and tax credits, healthcare, education, childcare, that kind of thing. In total, 4.5 trillion over 10 years in increased spending and tax credits, and of course, tax increases as well on corporations and very high income, well-to-do households to help pay for that, and it does pay for it on paper, at least over a 15-year period. So there's a lot there, and you did a lot of work on this. Really, when I say a lot of work, I mean a lot of work on this. Down into the bowels of the proposal. I know this may be an unfair question, but I'm going to do it anyway. What is your favorite part of all the things that he proposed? I mean, if you had to pick one thing, you say, I really like this, from a pick your criteria, macroeconomic perspective, income, wealth inequality perspective, however you want to think about it. What would that be?
I would definitely say the child care issue, the child care spending, to make it more affordable for low income households, because again, there's several reasons why labor supply is lacking, but I still think that child care is a big issue. If you look at the household survey, the pulse survey that the Census Bureau has been conducting most weeks since the pandemic, we're looking at about 6 million adults who are not working, have regularly not been working over, during the pandemic because of children who are not in daycare or in school. So I think that's a big thing to address, and I think that's a lot of people have been saying, oh, the American Families portion of the the Build Back Better is going to be tougher to pass, but I think that's one thing that should be a slam dunk, especially if we're so concerned now about supply. And I think looking at how fast rising relative to just all prices of goods and services, I think it's a good thing to do to sort of to sort of reverse or at least halt a lot of the the prohibitive cost of childcare. So I think if anything, the pandemic has made this a very salient issue that should be addressed.
And there's a couple of things going on here with regard to childcare. You mentioned the child tax credit, and that's part of it. But the other thing you're talking about is for families that spend more than 7%, I believe, of their income on child care, they will be able to get this benefit to help pay for child care. That's what you're talking about.
Exactly. Yes.
Yeah. And that's an idea that's been kind of out there for quite some time. That we actually did. Sophia Korpechki, one of our other colleagues, and I did a paper when Elizabeth Warren, Senator Warren, during her campaign, came out with a very similar kind of plan. So that paper's out there. People are interested in taking a look. Okay, so that's what you like the most, and I think that's because you guys aren't expecting any children, are you? Or
no.
Okay.
Wow.
Well, we'd be the first to know.
Not now. Yeah.
Inside Economics wants to be the first to know if that ever happens.
Okay. Yeah, at least not while she's in law school.
Okay, got it. That makes it. That actually makes a lot of sense. Okay,
Yeah.
well, here's a really tough question. Of all of the things that are proposed in the Build Back Better agenda, what is the thing you least like that if you were king for the day, you probably wouldn't have included in the package? Oh, look, he's taking his time. Hey, do you guys have something in the package you don't like? I'll ask you guys too after Bernard weighs in. Go ahead.
So yeah, I'd say I like this proposal, but I think it's going to be tough. Is the free community college, just because you have such a wide range of community college costs across the country, so it can be as high as $8,000 in I think it's Vermont, but then it's lower than $2,000 in California, just because California really does a good job in subsidizing the cost. And we still have to see how they structure it, but it seems like the the way the Biden campaign or the Biden administration has structured this, it's not going to be as favorable for a lot of these high tuition states, and you know they're going to have to bear much more of the cost. And you could end up with just a patchwork of states that you know some you know participate and many others don't. So it ends up being less effective, you know, than it otherwise would be. But in order to really make it very effective to get a lot of buy-in from all these states, it's going to require a much greater, you know, cost to the federal government than what is being contemplated right now.
Yeah, got it. So you're not against the idea of free community college. You're just saying implementing that might be pretty difficult, given.
Yeah, implementing it will be difficult. Also on the tax compliance side, so they're making the assumption that putting in some extra $80 billion in, you know, towards the IRS's budget is going to generate $700 billion in additional revenue from wealthy, high-income earners who, you know, many studies show may not be paying their fair share. That also seems a bit high, and given that that is the largest source of revenue that's being contemplated in the American Families Plan, you know, if that ends up being less than what they're suggesting, you know, that means more debt, more deficits over the course of the next 10 years than than would be expected, because based on the CBO's research, you know, they assume that, you know, probably for every dollar that you spend on IRS enforcement, you probably get $3 in additional revenue. So that suggests, you know, probably closer to, you know, 200 billion to 300 billion would be, you know, in additional revenue would be generated rather than the 700 billion that the White House is assuming.
Got it. Hey, Chris, Ryan, do you guys have any aspect of the Build Back Better agenda you want to call out, either something you really like or something you really don't like?
In terms of what I really like, I actually agree with Bernard. I think the most attractive piece is the early childhood education piece. In addition to the childcare, I think that's the responsibility of government, to my eye, and that's also sets us up for long-term economic growth, productivity growth that otherwise would not be met by the market left to its own devices.
Got it. You, Ryan, anything you want to?
I agree with Bernard and Chris. I think most economists across the board are going to, you know, pinpoint this as the key one. Did you see that the infrastructure part is coming down? Seems like the White House and the Republicans are going back and forth. It's down to 1.7. So
it was originally what was it, Bernard? 2.5, 2.3.
So it was 2.2 trillion. But again, a lot of that part of that 2.2 trillion included elder care, so increased Medicaid services, as well as made in America investments in these so-called made in America investments in R&D and manufacturing supply chain, which I don't think is part of the physical infrastructure talk that Republicans and Democrats are talking about now. So if you just look at the physical infrastructure spending, so, you know, roads, bridges, highways, broadband, that's more, you know, that's closer to about 1.3 trillion dollars. So it seems like they're closer. They're closer to where, you know, where Republicans are.
Yeah.
I hope the broadband investment, the broadband investment in Boston needs to be a top priority.
Yeah, that's,
exactly.
Earmark that.
Yeah.
I think it's dead on arrival though, still, right? Because as long as you have taxes in there, tax increases.
Why? You don't think they can get it through on reconciliation?
Oh, yeah, sure. That for sure.
Oh,
in
you
terms
mean the
of
compromise?
a grand
with the
bargain?
Republic-
Or,
No, I doubt that.
You know, even
They couldn't even
1.7.
agree on a commission to investigate January 6th. How are they going to agree on anything on that? So, hey, I did want to ask one question about the process. I do want to talk about deficits and debt, and I'm going to get to that in a second. But before I get to that, can you give us, Bernard, a sense of how you make the sausage here? Because, you know, this package comes out, you know, there's the Biden administration is actually pretty good in providing detail in the fact sheets that they provide, much better than, you know, other administrations. So we get, you know, some information, but how do you go from what's provided publicly to saying to, hey, Mark, this is what we need to do to drive our models? So can you just give us a sense of that? And by the way, you do this very, very quickly. I mean, it's shockingly quickly. So I'm wondering if you've hired anyone to help you that I don't know about.
No, so in general, when on the spending side, usually they'll say we'll spend this amount of money. So there I have the top line cost. And when it comes to the the next big issue is really how do I allocate this over over the next 10 years, and that I use past experience. We'll for infrastructure spending we'll use the pattern of outlays during the 2009 Recovery Act. So that's been a good useful rule of thumb for how how I distribute that over 10 years. Then also, I always am looking at the Congressional Budget Office. They score a lot of all sorts of legislation, most of which never see the light of day, on the floor of the, on the floor of Congress. But they also give, a pattern of distribution over, over a 10-year period. So that informs how, how, it informs, the ebb and flow of a lot of these spending policies. Over a 10-year period. Also, during the Obama administration, with each budget proposal, there would also be a series of revenue proposals that his Treasury Department put forth with a lot of tax policies and tax reforms, and obviously a lot of what Biden has been proposing is very similar to what Obama has proposed earlier on. So yeah, I'm able to also leverage that, those scores, those revenue estimates when I'm estimating, especially on the tax side, some of these proposals that Biden has put forth.
Yeah, you make it sound so simple, but it is really incredible what you do and how well you do it, how accurate you are. Because we can't make a mistake, otherwise, we got a problem pretty quickly. Because people are looking at these very, very closely, and I'm just gonna say I thank you for all the hard work you do here. It's
You're welcome.
really, really very good. Okay, I want to finally turn to deficits and debt. Clearly, we've added a lot of to the debt load. Just to give people context, and I'll give you a little bit of history here. I mean, if you go back before the financial crisis, from say World War II to the financial crisis, or soon after World War II, the financial crisis, the nation's publicly traded debt to GDP ratio was no more than 40%. Give or take. It had some cyclical elements to it, and varied over the business cycle by about 40%. It doubled during the financial crisis because just how bad that crisis was and how hard it hit the economy. And of course, there was some fiscal deficit finance, fiscal support then as well. So we went from 40% to 80%. And now, given the pandemic, it's jumped to over 100%. I think last I looked, we're like 103, 104%. And that doesn't yet include all of the deficit spending related to the ARP. So when that kind of all gets into the data, we're probably going to be about 110%. And the highest it's ever been is 105, 6% immediately after World War II for obvious reasons. So that's just that's context. So given that, people are kind of, I get a lot of emails about the UI program. I also get second most emails about our deficits and debt. Shouldn't we be worried about that? So question to the group, should we be worried about deficits and debt? I mean, there's, I guess, some folks that say no, but, what do you think? Bernard, I'll start with you.
Yeah, so when you talk to a lot of people about the federal budget, I think people make the mistake of equating it with a household budget, and the two of them are very different. So, the federal government is, it's an infinite-lived entity. It doesn't have to retire its debt at any point. It can borrow with the expectation that future generations will pay it off or service, these obligations. Whereas, when you think of a household, they have to retire their debts at some point. You can't go to a bank, ask for a loan, and say, my grandchildren are going to pay it off, all these decades later. So, that's one point, which makes me think, it's it's not as pressing a concern. Also, the standard measure of, the debt burden is obviously debt to GDP ratio. And I think that this can also overstate, the burden of debt, because you're comparing a stock to a flow. So the numerator is, the stock of all debt that we've accumulated thus far, whereas GDP is really just the income that the economy is producing in a given year. So, the economy is going to continue to produce, GDP income, year and year going forward. So if you compare the debt to, the amount of GDP and income that's going to be created over a longer term horizon, it doesn't, the ratio doesn't look as scary, as it would if you're just, doing the standard measure of debt to, to current year GDP. But I do think, at some point, debt and deficits, have to matter, will matter. But I would say it's more the momentum in the debt that matters, not so much the level. So if we were to somehow hit 200% debt to GDP ratio, but as long as that ratio sort of stays stable, I don't think investors are going to worry so much, because it'll show, the stability in that ratio will just show that the government is doing something, whether it's immigration reform, entitlement reform, or tax reform, to keep that that ratio stable. Whereas if you see the debt to GDP ratio rising by a few percentage points each year, year after year, and without any signs of stopping or slowing, then that's when I think we really get to sort of a breaking point where you could get sort of a crisis of confidence, and investors start to ask for higher interest to compensate for the risk of not getting paid back, and then you really interest payments spiral out of control, and
You're saying
something unprecedented. Yeah.
You're saying it's high, but as long as it's high and stable, we can navigate through, no big deal. But if it continues to move higher, at some point, investors are going to say, oh, I can draw a line based on these data points, and the line is taking me to a place where I really don't want to go. And
exactly. Yeah.
Okay. Got it. What do you guys think? What is your view? Are you as sanguine as Mr. Yaros is here on deficits and debt?
Yeah, I'm not worried about the deficit in the near term. I think we've discussed like the interest payment as a share of GDP is still really, really low. So even in a rising interest rate environment, as long as rates don't, spike, we're going to be fine. But as every Fed chair would say, we're on an unsustainable path, and we got to address this at some point. But we're more like Japan when it comes to deficits and debt than we are like Greece. So we're not going to have a sovereign debt crisis in the U.S. anytime soon.
Oh, that's interesting to think about it. Chris, do you take a different position on this?
No, I
Too
agree
bad we
with
don't have our colleague Dan White here. I think he might take a different position. What do you think, Bernard? Would Dan be, too bad he had to take the day off or something?
He'd be arguing
he would.
Yeah. Yeah.
So because in our baseline forecast, for example, we're assuming that sometime in the 2030s, legislators are going to have a wake up call, and they're going to do a mix of all types of reform, immigration, tax, and entitlement. And really the bang for the buck when it comes to, keeping the debt under control is entitlement reform. But obviously that's politically, treacherous territory. But I think a potential wake up call will be when the insolvency facing Social Security really becomes very close. And that's supposed to be, in early 2030s. So, given how salient, Social Security is for the general public, I think that will be, that will be a call to action for Congress to do something. And I think, despite how partisan we have been, how partisan, Congress has become, still, if you look back at last year, Congress rose to the occasion. We did a tremendous amount of stimulus. When push came to shove, we still, Congress delivered. And I think the same can be assumed, going forward when it comes to,
I like that.
the debt.
I like that optimism. That's hey, Chris, do you have I cut you off.
Yeah, I'm not nearly as optimistic, unfortunately.
Okay. You it.
Well, he's Italian, so I mean, he's being biased by his experience in Italy.
That's a good point.
Yeah, I think the problem is, sure, debt is not a problem today, deficits are not a problem today, but when they become a problem, when suddenly it is an issue, then you have no room to maneuver, right? So the time to act, the time to think about it is now when things are relatively stable. But like climate change, right? At some point, things can get away from you, and at that point, you have no more, have no more options, right? You have to enact austerity or take very aggressive actions that would be very punishing, very damaging. So I think we need to put the focus back on debt and deficits at this point, and I would also put everything on the table. No, right? There's no sacred cows here. The defense budget, everything should be fair game in terms of trying to get back to a more balanced situation.
Way to end the podcast.
It's really going to be.
On an encouraging note.
Well, we're not done yet. I got my 3 cents.
He's got his 2 minutes.
I'm going to lecture. Yeah. Hey,
Yeah.
and we are getting late, and this is turning out to be a pretty long podcast. So, Bernard, I know you got more to say, but I'm going to cut you off. Sorry. And we are going to wind it down here. I want to say a few things. First, I agree with Bernard that lawmakers, the Trump administration, now the Biden administration, and the two Congresses have done a very good job responding to the pandemic, that they provided a substantial amount of support. By my calculation, about $5 trillion worth of deficit finance support, about 25% of GDP, and that saved the day. And I think that if they had not done that, the economy would have been substantially weaker and our fiscal problems substantially worse because of the tougher economy. Unemployment would be higher, and thus government spending higher because of the automatic stabilizers in the budget. Revenues would be a lot lower. Of course, the stock market would be a lot, everything would have caused our fiscal situation to be a lot better. So I think we really didn't have a choice, and at least not a good economic choice. And fortunately, policymakers, lawmakers did the right thing. I will say, though, it took a little bit of pressure for that to happen. Here, I'm going to say something that may be a little controversial. I'm not so sure we would have gotten all of the support if not for the Georgia Senate races, right? Because you remember the Georgia Senate races, they were under Republican control. We had the November election. The margin of victory for the Republic wasn't wide enough, so there had to be a runoff. And as soon as it became clear that those races were competitive, that's when Congress and the Trump administration came together at the end of December and passed a piece of legislation to support the economy. And by the way, if they hadn't have done that, I think there's a pretty good chance that the economy would have gone back into recession. You remember back in December, we lost jobs and the pandemic was raging. It wasn't clear when we were going to get vaccines. It was a pretty dark time. And because of that COVID package, that $900 billion package, it turns things around. And then, of course, the Georgia Senate seats flipped to the Democrats, and you got the American Rescue Plan, and now we're off and running. So, the history of all this may have ended up being very different, and our assessment of what lawmakers did may not be as glowing if, in fact, that might have been a different turn of events. Second thing I say is I agree with Chris. It's now time to really start thinking about our deficits and debt. That does not mean that we can't have a aggressive build back better agenda. We need infrastructure spending. We need to provide for childcare and healthcare and education. These are things that are investments in the economy's ability to grow. In terms of infrastructure, it's about productivity, mostly about productivity growth. In terms of the social programs, that's, as we talked about, mostly about labor force participation, getting people back in. If we want a stronger long-term economy, we need to do those things, but we need to pay for them. And that means if we're going to do this, we do need to raise taxes. I mean, it makes sense to raise taxes on large corporations and on the well-to-do and high-income households, because they're the ones that got the big tax cuts back a couple of years ago, and their effective tax rates are about as low as they've ever been historically. So normalizing them, to me, makes a lot of sense. But I don't think we should pass legislation that now doesn't pay for itself. By the way, that's both in a long-term sense, because I do think we need to be worried about our debt load and what that means for future interest rates, but also in a near-term sense, because with the American Rescue Plan and all the other things going on in the economy, we are going to get back to full employment. So if you have deficit financed fiscal support with an economy at full employment, becomes very counterproductive very quickly. You have inflation, higher interest rates, you overheat, and you can go back into recession, which nobody wants. So, I mean, even if you're not buying into the need for, fiscal restraint long run, in the near term, I think there's a logical argument to be made. I do think the Build Back Better agenda that the president has proposed is a good one, but in significant part because it's paid for. But there's a lot of ground to be covered here, a lot of script to be written. Bernard, we're going to have you back and help us digest all of it. And the next time we're going to get Mr. White in on this conversation. I think he would spice things up a little bit, more than a little bit. I think he's got a different perspective on things. So with that, we're going to call this a podcast. Everyone, thank you for attending, and we'll talk to you next week.